Hey guys, welcome today. We're talking about the ultimate hedge. Basically, a very, very interesting way to protect your portfolio if you have positions using stock in your portfolio using option strategies. We'll go through an example here and we'll talk about the pros and cons of this strategy as well. So this is titled Financing Short-Term Protection with Longer Dated Covered Calls. Zero cost collar for hedging binary event risk overall, right? So the cost overall is nothing. And we'll use an example here as well. Um, what we'll cover here is the problem, right? Why a bullish long-term holder still fears a short-term binary event. You may be wondering, you're holding shares of Tesla or SpaceX or something that's more risky perhaps in your portfolio. In this case, we're going to be looking at a more um, nuanced approach using Microsoft as our case study. But nonetheless, if you want to understand how to protect your portfolio longer term, individual positions wise, this is a great strategy for you. The structure here we'll talk about is selling a longer dated call option to finance a shorter dated put option for protection. And as I mentioned, the case study here will be using Microsoft as an example. We'll discuss all the premiums, strikes, and expiration dates as well. And then the payoff overall, mapping the cap upside and the predicted downside as well. And then finally, we'll finish off with benefits and drawbacks. And yeah, let's dive right into it, guys. All right. The problem here is having conviction versus having risk in binary events in a position, right? So we've all experienced this where we've owned a stock that we believe in for various reasons. I'm a fundamentalist. I do a lot of research on each company, and I understand the value of the company. And when the pricing is not aligned with that overall research or fundamental value that I perceive, that's where I see opportunity, right? In this case, you might believe a stock is going to run over the next, half year, for example, but the next few weeks might have a lot of risk. Perhaps you have, for example, an earning event, right? Earnings have just started right now. Or you have a macro event like FOMC, for example, in a few weeks. Or you have a larger event like midterm elections, for example, which are approaching pretty fast, right? So with earnings, a single report can cause a massive gap in a given stock by 10, 20%. We saw today already with IBM. IBM is down 25% or so today on their report. Macro events, as I mentioned, FOMC, Fed decisions, CPI prints, which we had today as well, rate announcements, these move the entire market typically very quickly. The last thing is idiosyncratic shocks, litigation with the company, guidance cuts, or management changes can strike without any warning at all. And that can leave us holding a bag perhaps for a long time. If you bought some certain names at higher prices, a ServiceNow, a Salesforce, for example, at a higher price, you may be bag holding right now, perhaps, right? Now, the issue here is if you sell the whole position, that sacrifices long-term upside. Doing nothing exposes you to a short-term shock in your portfolio, perhaps on a downside move. And the strategy here is built to resolve that tension at close to zero cost. Now, you can build different permutations of this strategy. I'll discuss that after as well. But I want to keep this more succinct, right? So the structure is called a diagonal collar. In this case, it's a calendar collar overall, right? So you open two option legs, two different expiration dates, and one is financed by the other. So what happens here? You own 100 shares of a given stock. You're obviously bullish on that stock because you're holding it. That's the first component. Because you own 100 shares of stock, you have the ability to sell or write a call option against your 100 shares. So what you do is you collect premium against the shares you already own, and this pays for your hedge. But what you're doing is you're selling far out of the money on a longer dated option for the purpose of keeping upside on your stock. Otherwise, you're pretty much maintaining a low upside proposition if you're doing a same expiration short dated position. And then finally, what you're doing is you're using that call premium from the selling of the covered call to finance a shorter dated put option, which acts as insurance. This caps your downside in the short term at the expense of capping your upside in the longer term, right? We'll use a very precise example in a second too, right? But this protects you through a binary event like earnings, for example, right? We've all seen many events like NVIDIA is a prime example where they will blow out all the numbers, EPS, revenues, guidance, etc. They'll do phenomenally well, and the stock price will price down after earnings, right? So it isn't a guarantee because a given stock reports positively, they'll have a positive reaction. Now, the overall result here is that when the put premium equals the call premium approximately, the hedge costs little to nothing out of pocket, meaning that you're not spending any of your own money on insurance at all whatsoever, which can drag your returns. Now, the position will trade away some of the upside above the call strike or downside protection through the put's expiration date. And here's an example right here. So Microsoft, the setup is, keep in mind, this is as of yesterday. I made this yesterday, not today. So the setup is July 2026, and this is an actual example. So you own 100 shares of Microsoft at the price of around 380 per share, which is around the spot price. I think we're like 387 right now as I speak. But regardless, yesterday we were at 390 roughly. So what do? The first thing you do is you sell a covered call, one call option per 100 shares you own against your stock. January expiration. This is January 15th of 2027, about 6 months away roughly. And the strike price is $500. So notice how this is $120 above the current spot price. A lot of upside allowed on the current a lot of upside allowed from the strike price to the current price. Upside here is about 31%, 32% roughly, into January from the current price. So you're pulling in $12.50 per contract by selling this contract over here. Then what are you doing? You're taking that premium and you're purchasing the August 21st, which is about a month and change away, put option just below the current strike price. I mean current spot price at the 370 strike price put option, right? And the cost here is about $12 per contract, which means that your downside from the current price is, when I wrote this, from 380 down to 370 roughly, right? Now it's 387, so like 387 down to 370, for example, right? So your drawdown will vary depending on when you watch this video, obviously, but the point being that your downside is very, very muted overall versus your upside, which is much, much higher overall. It's like 25, but it's 15 times higher than your downside overall on the upside. Now, what happens here, right? So you receive call premium of $12.50 on that covered call at the 500 strike for January. You pay $12 for the put premium. Net, you're getting a credit of about 50 cents, right? So the overall cost here is nothing to you. You're actually receiving a credit. So the position pays for its own insurance. And again, you keep your upside of about 32% in the January OPEX if you're called away at $500, including the credit received. Or if we drop perhaps after earnings, keep in mind, Microsoft has earnings on July the 30th. So in about 2 weeks roughly, they'll report earnings. This could cause a massive, massive movement into that event overall, or sorry, after that event. And so the August expiration hedges you out 3 weeks past the earning event, right? Such that, let's say, for example, the stock price tanks down to 340 or 330 as an example, right? What happens then? Your 370 put option is trading for $40 or $50, depending on where it goes. So you're hedged into that binary event. You're therefore not really worried about holding on to your position through the binary event. Now, the price range you have in this, between 370 and 500 is about 68.42% price range with full participation there overall, right? Doesn't really mean much to you overall, but look at the payoff profile here, right? So what happens here is below 370 into August, you have full protection here. If we trade, for example, below 370, nothing happens with your position. You're down like about $10 per share, given the delta between 380 and 370. However, if we push much higher, let's say we push to towards 500, you still have upside of 120 per share, whereas you're dampening your downside into the August expiration. Now, keep in mind that obviously, one of the problems here is that the put expires the put expires well before the call option does. So your protection only applies for the next, roughly month and change, right? Like month and a week, roughly, right? 5 weeks, let's call it. So that's important to note because again, you're only paid for the next 5 weeks, but the idea there is that you're protecting yourself through a binary event, which is the earning event on July 30th. So over here, you can see the time asymmetry, right? The put option covers you for 5 weeks. However, on the call side here, you're not protected. Sorry, beyond the 5 weeks, you have no protection at all, right? Because after this expires, you have no more protection whatsoever. But again, the idea here is that you want to protect yourself through a binary event. It doesn't really matter after that because if the earnings are good, for example, and it pushes to like 420, 430, 440, 450, you don't really care so much. Your stock price is appreciating and it's no expense to you at all because your hedge costs you nothing at all whatsoever, right? So you're keeping upside while maintaining muted downside overall through a binary event. But again, keep in mind that you after the August expiration, August 21st, you no longer have any insurance in place. You may need to roll it forward if you want to maintain a hedge. Again, I wouldn't look at maintaining hedges on positions that I believe in longer term. It's more so the binary events that elicit the most risk because you might have some repricing event which happens, right? Let's say, for example, earnings are not as they're expected and they're far lower on EPS or guidance, for example. Or in this case, Microsoft has been influenced recently due to their CapEx. Let's say the CapEx increases further, eliciting a movement down of 10%. That would be an adverse reaction through the binary event, which this position would give you insurance on overall, right? That's what you're buying this position for. You're not buying it for a long-term hedge because long-term hedges drag on returns and net out overall, right? And then obviously the call option expires in January of next year, right? So you're pretty much financing it with a 6-month out call option, roughly. Um, Now, what happens here is that if we push to the upside, for example, and the put option diminishes in value, well, I mean, obviously after the event, if you have positive information in your pocket now, what do you do? Well, at that point in time, you can close the put out for a partial loss, maybe keep the covered call on because it'll inflate in value as we push for that strike price, and just keep the covered call on until pretty much expiration. And the idea here is that you need to be okay with losing your stock at $500 per share, right? Which a fair number of people would be okay with doing if they thought, hey, if I can make 32% return in 6 months, is that, a good proposition for me? And most people would say yes, right? So that's kind of the trade-off here is that you're capping your upside in the short term. If it pushes to the upside, you got to be okay with keeping the call option on, right? But also, you can buy it back prematurely if you wanted to, for example. There are many different ways you can play it. If, however, we decline, let's say we drop down, what happens there? Well, the put option inflates in value. So let's say we go to for argument's sake, we go to $300 per share. What happens there? The put's worth now $70 overall. The call option you sold is worth far, far less than what you sold it for. At that point in time, you might think, okay, either you want to keep holding your position in Microsoft, in which case you want to sell the put option for a profit and not use it for its intended purpose and assign your shares to someone else using the put option. In that case, what you do is you sell the put option for a profit, buy back the covered call for a profit as well, and you net out pretty much a loss of about $10 per share from the 380 mark to 370 roughly, right? Um, and then the nice thing there is that if it pushes back up again, you have more upside again, right? You would subtract the profit from your position here from your cost basis on your overall stock position. Let's say, for example, your cost was like 380, and you made like let's say $75 profit on this kind of structure for a hedge. You would then subtract that from your cost. Your new cost would be 305 from 380. Right. Now there are pros and cons to the strategy, right? The benefits are almost zero cost in most cases, right? In this case, there's no cost at all. You get an actual credit because you're using the call premium to finance the put option as a hedge. So it doesn't drag on your returns at all. The second thing is you're maintaining upside of about 32% into end of this year, which is not too bad at all whatsoever. So you don't want to be very tight on this and keep your upside capped at a very, very low number because ultimately you're holding an investment with the intention of making a positive return and hopefully a substantial return as well, right? So if you're selling, for example, a $400 call option, which has a lot more credit to give, you're also capping your upside significantly, which is not the purpose of the strategy. You want to maintain a lot of upside, and that's why we're using a longer dated call option way out of the money. Because in more time, you get more credit, which is able to pay for that close to the money put option through the binary event, right? Nice thing here is, again, no capital required for the insurance overall, right? It's a free hedge. It targets the actual risk of the binary event instead of paying for a full half year of insurance. Let's say, for example, you're in Florida and you have a condo or a house, and the insurance company said, "Hey, we can offer you insurance just for July, August, September, October, 4 months of the year where it's hurricane season, right? Would that be more ideal than paying for it for the whole year? Probably yes, right? Same idea plays out over here. You're hedging through binary events, which are earnings or FOMC. In this case, you're covering earnings and FOMC for July as well, right? Um, the benefit here is it reduces your overall volatility in your portfolio. So you're not going to see as much, downside perhaps. You still have upside protection, but upside projection. But again, you won't see much downside overall in the short term because you're hedged. And the other benefit is it's very flexible. Again, you can buy back your covered call when you want to, sell your put option when you want to, or you can roll your put options forward if you want to do that again and again, which I would not recommend because, again, you're hedging through a binary event. You have conviction on your investment thesis, which is why you are holding a name like Microsoft, for example, right, at a lower valuation. There are some drawbacks as well, however. As I mentioned, the insurance or protection is temporary, right? So after August 21st, in this case, position is now naked below. So your risk is now unhedged, right? Your upside is capped, which we discussed already. You have assignment risk if, for example, the stock price trades above $500 per share well before expiration. It's possible that the counterparty to your trade on the call option decides to call in your shares from you, which would then take your shares from your account at $500 per share. But again, if the price gets to $500 per share, at that point in time, you can revisit the overall structure and determine what the best course of action is then. The next thing is ongoing management burden. If you want to roll the position forward, which again, I do not recommend. There's also some tax considerations here, which I won't discuss today. And the last thing is that it doesn't cover a slow bleed. So say, for example, that Microsoft drops, a few dollars per day over the next month and a half. You don't really get much benefit out of the put option because it won't monetize at all, right? Let's say it drops down to 370 and we're at August 21st, it expires worthless. Now you have no hedge in place and we're down $10 per share roughly, for example, right? But again, at that point in time, you can reevaluate with the information in your hand from the earning event, from the FOMC and say, hey, do I want to own this stock still at this current price based on the information I have in hand, right? That's kind of what we're doing here. And so just to summarize again, right? So key takeaways here. One, a longer dated call option can finance a shorter dated put option, hedging a binary event at little to no cost. Two, in the example with Microsoft, the investor keeps almost 32% of upside room while capping downside to only about 2.5% through the August OPEX. Three, the hedge is time bound. Protection ends when the put expires, well before financing the call does, right? The call option expires, which is in January, right? Number four, this trades some long-term upside and adds management overhead in exchange for cheap, targeted short-term insurance. And lastly, as I mentioned, if the stock trades down below the put strike, it can be monetized while the covered calls are moved or lowered, both for a profit, right? And we will end it there. If you have any questions at all, drop them in the comments below. And yeah, I'll do some Q&A in a second. Let me just drop the record here.